This podcast is for educational purposes only and is not financial advice.
Yeah, that is definitely important to keep in mind.
Welcome to the 15-Minute Investor. Today we're covering timing the market bottom during a bear trend, 3 critical reversal signals to watch, and what institutional stealth buying in stocks like Meta tells us about the future.
There's a lot to unpack with what's happening out there right now.
Links and resources are in the description below. If you find this podcast helpful, please consider subscribing and help us reach our first 1,000 subscribers as we build a research-informed investing community.
We'd really love to have you join us.
So welcome to today's deep dive. If you look at the market right now, everyday investors are honestly panicking.
Oh, completely.
You open any standard brokerage app, and it is just a sea of red. People are convinced their portfolios are literally going to zero.
Yeah, the fear is palpable right now.
But, behind closed doors, Wall Street's biggest whales are quietly executing this multi-billion-dollar shopping spree with your discounted shares.
Right. It is a brutal environment for the average person, without a doubt. We are deep into a bear regime right now.
Which means what exactly for the everyday listener?
Well, we're specifically going through what the industry calls a distribution phase.
Okay.
In plain English, that simply means the big institutional players have been steadily unloading their shares. They're basically taking profits after the huge run-up we saw from the April 2025 lows.
Got it. So they're cashing out.
Exactly. And that relentless selling pressure creates this dark cloud of fear, uncertainty, and doubt.
Right, the FUD.
Yeah, the FUD that completely dominates the financial news. The pundits on television just keep kicking the market while it's down.
It makes it feel like the bleeding will literally never stop.
It really does.
So our mission today is to cut right through that emotional noise. We want to give you the clear, data-driven signals required to know when this painful trade is finally over.
Because before we figure out how to spot the exact bottom, we really need to understand why a turnaround is fundamentally expected in the first place.
Right. And that brings us to a fascinating macro backdrop. We are right in the middle of a midterm election year.
Yeah, and that calendar detail alone acts as an immense underlying catalyst.
How so?
Well, historically, and we are seeing this pattern play out right now, political leaders have a strong vested interest in the stock market's performance.
Sure, they want people to feel wealthy.
Exactly. Incumbents want to push these sweeping legislative agendas. They want to engineer a grand victory march to make the broader economy look robust for everyday voters heading to the polls.
Right, a booming market makes them look good.
It does.
Yeah.
And this dynamic naturally drives the announcement of new deals, creates new trade alliances, and pumps much-needed liquidity right back into the financial system to, boost asset prices.
Now, we need to state very clearly for everyone listening, we're just taking no political sides here.
No, not at all.
Our goal isn't to praise or criticize any specific administration or party. We're strictly analyzing the objective historical thesis that incumbent political pressure often acts like a giant ping-pong paddle.
Yeah, that's a good way to picture it.
It bounces the stock market off a bearish wall and forcefully slams it right back into a bullish trend.
Because it really boils down to basic human psychology and market liquidity rather than partisan ideology.
Right.
When the people currently in power desperately want the economy to look like a relentless winning machine, they pull various economic levers that heavily support stock prices.
They want to stand at a podium and declare victory.
Exactly. And the stock market very often responds positively to that incoming wave of engineered optimism.
Okay, let's unpack this. If we know a political pivot is almost certainly coming,
Right.
and that the market will eventually be pushed higher by these macroeconomic forces, why can't I just buy any green day I see right now?
Yeah, that's the trap.
Like if I know the floor is approaching, why not just catch the falling knife?
Because doing that is usually how you decimate a portfolio in a downtrend. The golden rule you must follow right now is don't trust the green, trust the red.
Don't trust the green.
Right. In a deeply entrenched bear market, a single green day is almost always a trap. It's basically a temporary mirage.
Designed to trick people.
Exactly. Designed specifically to lure in eager retail buyers before the next aggressive leg down.
Wow.
Similarly, you have to watch out for a bald red candle.
A bald red candle. Meaning a chart indicator with no wick at the bottom.
Precisely. If you look at a daily stock chart and see a steep drop with absolutely no bottom wick, it means there was zero buying pressure at the very end of the trading day.
Oh, so nobody was stepping in to buy the dip.
None. The sellers maintained total control straight into the closing bell. If a day ends like that, it tells you the downward momentum is still fully in charge. We are not at the bottom yet.
Which is, a tough pill to swallow when you're desperate for some relief in your portfolio.
It really is.
So if a random green day isn't the actual bottom, we need concrete metrics that prove the worst is finally behind us.
Yes, the real data.
You brought 3 specific ironclad signals from our research today that cut through the noise.
I did.
Let's start with signal number 1, the VIX. The data says we need to see the VIX broadly spike into a very specific range between 40 and 60.
Yeah, that 40 to 60 zone is crucial.
Let me jump in here with a quick analogy for you listening. Think of the VIX essentially as Wall Street's ultimate fire insurance policy.
Right.
When institutional investors get terrified that the market is going to crash, they rush out to buy financial protection. And just like in the real world, when everybody rushes to buy fire insurance at the exact same time because the whole neighborhood is burning, the baseline cost of that insurance skyrockets.
That is a highly accurate way to visualize the mechanism.
Thanks.
When the VIX successfully hits that 40 to 60 level, maximum fear has officially been reached.
The neighborhood is fully ablaze.
Exactly. The biggest, smartest players have heavily hedged all their bets, meaning the worst of the blind, emotional dumping is likely exhausted.
Wait, hold on. If the VIX is spiking to 60, doesn't that mean the market is literally crashing?
It does.
So why on earth would I want to look for buying opportunities when the house is visibly burning down?
Because the stock market is entirely forward-looking. By the time the VIX actually hits 60, the panic is already priced in.
Oh, I see.
The weak hands have completely sold out of their positions. However, fear subsiding is not the same thing as an aggressive new bull run.
Right. The fire stopping doesn't mean the house is rebuilt.
Exactly. We need concrete proof that Wall Street is going on the offensive once again. That brings us to signal number 2, the Zweig Breadth Thrust indicator.
I have to admit, Zweig Breadth Thrust sounds like a laser weapon from a 1980s sci-fi movie.
It really does.
What does that actually mean for a regular investor?
It does sound incredibly dense, but the core concept is straightforward. Mechanically, the indicator triggers when a 10-day moving average moves very rapidly from below 40% to above 61.5%.
Okay, let's strip away the math for a second.
Sure. It simply means looking under the hood of the stock market to see if a vast number of entirely different stocks are suddenly being bought all at once.
Oh.
Imagine walking into a giant shopping mall. If only the Apple store is busy, that's not a healthy mall.
Right.
But if suddenly every single store in the entire building has a line out the door, you know a widespread spending spree is underway.
But why the strict 10-day window? Why does it have to happen so rapidly?
Because true institutional buying cannot be hidden. When billionaires and massive hedge funds decide to buy, they leave giant footprints in the data.
So it happens fast and big.
Yes. If the entire market rises broadly over a very compressed 10-day window, it proves this isn't just a one-day fluke or a temporary release rally.
It proves Wall Street just deployed serious, sustained capital across the entire market.
Exactly.
So signal 1, the VIX shows us that max fear has peaked. Signal 2, the breadth thrust, proves a widespread shopping spree has started. What comes next?
Signal 3 is the sudden appearance of a huge green volume node on the major market indices, specifically looking at things like the QQQ and the SPY.
And volume is simply a measure of the total number of shares changing hands, right?
Right. A giant green volume node is considered the ultimate market liquidity event.
Like a giant sponge absorbing water.
Yes, exactly like a sponge. During a panic, retail investors dump their shares at terrible discounted prices.
Out of pure fear.
Yep. A giant green volume node visually tells us that institutional money has stepped in to absorb all of that panic selling.
Wow.
They are taking those shares at a steep discount, which is definitive proof that they are locked and loaded for the next bull run.
So what does this all mean for me today? Do I have to sit on my hands and wait for all 3 of these signals to flash in perfect unison?
Not necessarily.
Because if I wait for the magical alignment of the stars, I feel like I might miss the boat entirely.
Yeah, you do not wait for all 3 to perfectly align on the exact same day. By the time that third signal completely confirms itself, the absolute rock bottom price is already in the rearview mirror.
Oh, I see.
Instead, identifying the general range of these 3 signals gives you the safest entry zone possible.
You're looking for the neighborhood,
Yeah.
not the specific house.
Exactly. You are looking for an environment where the VIX has spiked significantly, breadth is thrusting rapidly upward, and heavy volume is stepping in.
Finding that specific zone stops you from buying too early and getting crushed by a false rally.
Correct.
Here's where it gets really interesting, though. While everyday retail investors are nervously waiting on the sidelines for these signals, the smart money is not just sitting still.
Oh, definitely not.
Let's look at a concrete example happening right now: Meta.
Meta is a genuinely fascinating case study in current market mechanics. I mean, the stock is dropping incredibly fast.
It's breaking down through major long-term support levels.
It is. If you look at the weekly chart, the Relative Strength Index, the RSI, which acts as a momentum gauge, is dropping rapidly below the 40 mark.
And that's bad.
While that lower 30 level on the RSI is currently acting like a gravitational magnet pulling the price down, it could very easily hit $500 a share as the broader market continues to bleed.
And yet, despite this free fall, despite the stock chart looking incredibly ugly today, major financial institutions are quietly loading up on Meta call options, specifically for the year 2027.
Yeah, they are buying what are called APS.
Right. For those who might not know, EPS are simply long-term bets that a specific stock will rise significantly over the next few years.
Exactly. They are options contracts that don't expire for a very long time, giving the stock plenty of runway to recover and soar.
So the everyday retail investor is sitting at home, looking at their screen as Meta drops toward 500, panicking, and asking themselves, should I sell my long-term positions today before I lose everything?
And that psychological trap is how wealth is transferred. Retail investors often act as emotional money.
While institutional investors act as cold, calculating money.
Precisely. Do not hand over your highly valuable long-term assets to institutional buyers at a steep discount simply because of a localized market panic.
Because they are literally using your fear.
Yes, they are using your fear to quietly buy your 2027 EPS and your long-term shares for pennies on the dollar.
They know the turnaround is coming.
Which is why they are stealth buying in heavy quantities while the overall stock price drops.
Which means there are distinct, highly profitable strategies that actually work right now, even in a punishing downtrend.
Smart investors are still making money.
They just aren't doing it by blindly buying the dip on unconfirmed green days. For instance, intelligent scaling.
Yeah, scaling in is crucial right now. If you fundamentally love a company like Meta over the long term, you do not go all in with your cash today.
You buy a small starter position right now.
Right. If it eventually drops further down to that 500 level, you simply double down. You systematically average your overall cost down during the bleeding phase.
And for the more active side of things, people are actively betting against the downward momentum.
Definitely.
We've seen highly successful short-term plays where aggressive investors are shorting major tech stocks. Some are pulling in 50 to 60% gains recently just by heavily buying puts on companies like NVIDIA as their stock price drops.
Because a put option structurally gains value as an underlying stock price falls, you can absolutely profit on the way down if you understand the mechanics.
Right.
Furthermore, even on the reddest, ugliest of trading days, there are always rare, isolated winners that successfully buck the broader market trend.
Yeah, just recently we saw a tiny microcap stock, RTL, completely ignore the broader market bleed and pop 87% in a single trading day.
It's wild.
But why does that happen? How does a tiny stock survive a day when Apple and Amazon are getting crushed?
Because money constantly needs a place to hide. Microcaps like RDL often have isolated catalysts, maybe a new patent, clinical trial results, or a buyout rumor.
So it has nothing to do with the broader market.
Exactly. These specific events have absolutely nothing to do with the broader economy's inflation rates or political cycles.
Right.
So in a sea of red, day traders and algorithms desperately rotate their cash into these isolated safe havens, creating an explosive surge in price.
That makes total sense.
Major opportunities still exist out there. You just have to look for them and remain strictly disciplined. Remove the emotion from your trading process.
Many investors are thinking through what this means for their own positioning. If this raised a question or perspective for you, feel free to share it in the comments.
It's a lot of strategy to digest.
So to synthesize everything we've thoroughly covered today into a few key takeaways.
Sure. First, we are trapped in a severe market downtrend. But underlying political and macroeconomic cycles, especially right now in a midterm election year, strongly suggest a major market turnaround is actively being engineered behind the scenes.
Right. And second.
Second, do not trust random green days in this environment. You must wait patiently for the three major indicators to officially flash their signals.
That's the VIX spike showing max fear between 40 and 60, a rapid breadth thrust showing market-wide buying, and a huge green volume node on major indices proving deep institutional support.
Exactly. And third, institutional smart money is currently using everyday retail fear to quietly buy up highly valuable long-term assets at a steep discount.
So the lesson is do not panic sell your long-term positions straight into their waiting hands.
Please don't.
It really all comes back to how we manage our own minds in the face of financial chaos. If immense institutional money uses our own emotional panic as their precise calculated entry point, how much of truly successful investing is actually about reading complex charts, and how much is just about fully mastering our own flawed human psychology?
That is the real question.
Thanks for listening to the 15-Minute Investor.